Welcome to our CFP Exam Prep discussion on gift taxation and estate planning. Today we're diving deep into how gifts are valued and taxed, a topic that frequently appears on the exam and often tricks even experienced professionals. Let's start with a fundamental principle that you absolutely must remember. Gifts are always valued at their fair market value on the date of the gift. This seems straightforward, but here's where candidates often make mistakes. They sometimes confuse this with the donor's basis or try to use year-end values. Remember this through a simple example. If you gift 100 shares of Apple stock on July 1st, when it's trading at $150 per share, the gift value is $15,000, regardless of what you paid for it or what the stock price does later in the year. Speaking of gift values, let's break down the annual exclusion concept. Currently, each person can give up to $17,000 per recipient per year without triggering gift tax consequences. A common exam trap involves gift splitting between spouses. When spouses agree to split gifts, they can effectively double the annual exclusion to $34,000 per recipient. However, here's the crucial part that trips up many test takers. Gift splitting requires filing a gift tax return and formal election, even if no tax is due. The exam loves to test this technical requirement. Now let's explore a practical scenario that illustrates several key concepts. Imagine a married couple wants to help their child buy a house by giving them $60,000. Without gift splitting, if one spouse makes the entire gift, they would use their $17,000 annual exclusion and need to report $43,000 against their lifetime exemption. However, with gift splitting, they can apply two $17,000 annual exclusions, reducing the taxable gift to just $26,000. This scenario often appears in exam questions with various twists. Another critical concept that frequently appears on the exam involves timing and documentation. Gifts must be completed and delivered to count for the current year's annual exclusion. A common mistake students make is assuming a check written in December but cashed in January counts for the December tax year. It doesn't. The gift is complete when the check is cashed. Let's address basis rules, which are particularly tricky. In a gift scenario, the recipient receives the donor's basis for capital gains purposes, but fair market value for gift tax purposes. This dual valuation concept confuses many candidates. For instance, if you receive stock that cost your parent $10,000 but was worth $50,000 when gifted, your basis is $10,000, but the gift value reported is $50,000. Remember these key points to avoid common exam mistakes. Never confuse basis with fair market value. Always consider gift splitting requires an actual election. Be clear about when a gift is complete. And most importantly, understand that the annual exclusion applies per donor, per recipient, per year. The exam frequently presents questions where multiple gifts are made to various family members throughout the year. Take your time calculating each gift separately and apply the annual exclusion individually. Don't fall into the trap of lumping all gifts together or assuming gift splitting without proper election. By mastering these concepts and understanding their practical applications, you'll be well prepared for the gift tax portions of the CFP exam. Keep practicing with scenarios involving multiple family members and various types of assets to reinforce these principles.